Welcome to this important financial disclaimer. Please pay close attention to the following information. It's crucial to understand the nature of the content you are about to consume. This disclaimer is here to clearly set the expectations regarding the information provided in this video or related materials. The content presented is for informational purposes only and should never be construed as professional financial advice. We are not licensed financial professionals, and the information shared is general in nature. The sole purpose of our content is educational and informational, designed to help you think about certain financial concepts. Any opinions or views expressed are strictly those of the author or speaker and do not represent professional endorsements or advice. It is absolutely vital to recognize the inherent risks associated with investing and financial decisions. Understand that every investment, regardless of how safe it may seem, carries some level of risk. There is a real possibility of losing some or all of your invested capital. Please be prepared for this reality. Past performance of any investment or strategy discussed is not a guarantee or reliable indicator of future results. Before making any financial decisions, we strongly urge you to consult with qualified professionals. This includes consulting with a qualified financial advisor, tax professional, or attorney relevant to your personal situation. Always conduct your own thorough research, or DYOR, before committing to any financial decisions or investments. In conclusion, your financial well-being is your sole responsibility. By proceeding with this content, you acknowledge and accept this financial disclaimer in its entirety. Thank you for watching and listening, and we wish you the best in your financial journey. Welcome. Ever wondered how central banks decide on the money supply? It's a complex but vital process for economic stability. The decisions made by a central bank regarding the money requirement are critical. They affect everything from inflation to employment rates. The central bank acts as the guardian of the nation's currency and financial system, responsible for monetary policy and economic stability. The process involves monitoring the economy, analyzing data, and using various tools to maintain a delicate balance in the money supply. Central banks rely heavily on key economic indicators to gauge the health of the economy and determine the money requirement. Inflation and price stability are primary concerns. The central bank must ensure that the amount of money in circulation doesn't lead to runaway price increases. They also analyze GDP growth and unemployment rates. The goal is often to stimulate growth and full employment without triggering inflation. To adjust the money supply, central banks have several powerful tools at their disposal. Let's look at the main three. Open market operations, or OMO, involves buying and selling government securities. This is the most frequently used tool to directly inject or withdraw liquidity from the banking system. Reserve requirements dictate the minimum amount of funds commercial banks must hold. Changing this ratio impacts the amount banks can lend, thus controlling the money multiplier effect. Setting the policy interest rate, such as the benchmark rate, influences all other interest rates in the economy, affecting borrowing, spending, and investment decisions. Decision-making isn't just about current data. It's heavily reliant on predicting the future through sophisticated forecasting and modeling. Econometric models are used to simulate various economic scenarios and predict how much money the economy will likely demand in the near and long term. Central banks must also assess domestic and global financial stability risks, ensuring that their policies don't inadvertently create bubbles or crises. Once a decision is made, effective communication and continuous review are essential for the policy to work. Decisions are communicated clearly and transparently to the market through press releases, speeches, and minutes of policy meetings to manage expectations. Monetary policy is not static. It's regularly reviewed, and adjustments are made based on new data and changing economic conditions to ensure goals are met. In conclusion, the central bank's decision on money requirements is a multifaceted process driven by data, tools, and foresight. The core objectives remain price stability, maximizing employment, and ensuring the smooth functioning of the financial system. Prudent money supply management is crucial for a stable, growing economy. Understanding this process helps us appreciate the work of the central bank.
If you found this video helpful, like, share, and subscribe for more simple finance explanations.